Hello everyone. With this demonstration, I'm going to explain the financial analysis spreadsheet and a bit about how the spreadsheet calculates the certain numbers that you input into this system. What you'll notice is from the instructions are you're going to change the input cost and benefits only, just the cost and benefits only. So you see in line 9, you're only going to change the cost. So right now, with this simple spreadsheet, each year for the 4 years, there's $100 per year spent. But then there's a discount factor created for each year. For the year 0, which is actually the first year, it is a 1. But then you'll see that it is modified for each of the 4 years because it's based on what's called the discount rate. Well, this discount rate is contrived because companies must plan their investments in projects. As they do that, they need to mitigate as much of the risk as possible. So they add a discount factor into their analysis based on what's called a capital asset pricing model. Now, you don't have to know anything about that. All you have to do is remember that there is a discount rate. So for our analysis spreadsheet, we use the value of 8% as the discount factor, which will modify our incurred cost and benefits, as we'll see later. So let's see what happens if I change this discount rate. Right now, our costs are $400 for the 4 years, and our benefits, in this case, there is no benefit for the first year or year 0, but then there is our benefits for the next 3 years of $600. But you'll notice the value of the cost and the benefits go down yearly because of the time value of the money based on this discount rate. So let's say the discount rate goes to 10%, and this will be based by what the chief financial officer working with other chief financial officers in that industry to compile that standard rate. So if we change this value to 10%, let's look what happens to both of the discounted cost and discounted benefits line. So I'm going to hit the enter key. You'll notice it went down in each case. So if I go, I'm going to change it back to something really small. Let's say 3%. The lower that it goes, you'll notice the time value of the money is increased in both the cost and the benefits. So if I go back to 8% again, which is what we're going to use, those values change. So that's how this net present value is calculated. And what you want to end up with is a positive net present value, which is simply the difference between the discounted costs over the life of the project and the discounted benefits over the life of the project. That gives you a positive net present value, and it also gives you a return on investment. It also explains when the payback year is. So some things you will notice then is this first year, which is year 0, typically you might not have a lot of benefits for that first year, but you could based on the type of project you have. But what you want to end up with are different benefits spread out over the 4 years that are larger than your cost. You'll always want to have your benefits higher than the cost, or there's no reason to have the project. Or if you had a really small margin and the project was something that was more philanthropic, then it could still be approved. But typically, you want to have a positive net present value and a positive return on investment and a payback year around that second or third year. So what you'll do then, the only thing that you do is enter money into the cost row for each of the 4 years, and that'll be based on the original investment that the company gave your team, and then you want to put in some of the values of the benefits for each of the 4 years, and then you will end up with a positive net present value and a positive return on investment. So, and then of course you want to make sure that you put in your project name here. For the created by, you could put in just your team name and then the date of the project. So really this is a pretty simple spreadsheet as long as you don't change anything such as the discount rate, and you only enter values into row 9, which are the costs for the 4 years, and row 13, which are the benefits for the 4 years. And the benefits should probably increase from year 0 to year 3. Not necessarily. They probably shouldn't be the same for all 3 years. And year 0 should probably be a smaller number than the progressive years. So the idea of this spreadsheet is to explain that as the longer the project continues, the lower the cost will be of value and the less benefits that you will have. So there again, you would end up with a positive net present value, a positive return on investment, and a payback in year 1 or 2, probably. So that's when your money are starting to go positive for your investment. So that's how this financial analysis spreadsheet works.